Ever wondered who Warren Buffett, one of the world's most successful investors, credits as his mentor? The answer is Benjamin Graham. This man, Graham, is a luminary in the world of finance, a pioneer in the field of value investing. His influence on the investment world is immeasurable, and his wisdom has been encapsulated in his seminal work, The Intelligent Investor. Now, this isn't just any finance book. This is a book that has shaped the investment strategies of many, including the Oracle of Omaha himself, Warren Buffett. Buffett was not just a student of Graham, but has often stated that his investment philosophy is a reflection of the teachings of his mentor. So you might be wondering, what's the secret sauce? What did Benjamin Graham teach that made such a profound impact on Warren Buffett and other investors around the world? The Intelligent Investor, written over half a century ago, is a timeless guide for anyone stepping into the world of investing. Penned by Benjamin Graham, this classic has been a beacon for countless individuals and even legendary investors like Warren Buffett. It's not about hot tips or quick riches, but rather the enduring principles of long-term value investing. Imagine you're a farmer, and your crops are your investments. You wouldn't abandon your field because of a single rough season, would you? Similarly, value investing encourages a focus on the long-term potential of investments rather than the short-term market fluctuations. It's about buying shares in a company as if you're buying the whole company, not just a lottery ticket for a potential windfall. Now let's meet Mr. Market. Graham introduces this character as a metaphor for the stock market. Some days, Mr. Market is overly optimistic and demands high prices for his shares. On other days, he's pessimistic, offering to sell his shares for a pittance. But as an intelligent investor, you are not swayed by Mr. Market's moods. You use your analysis, judgment, and patience, buying only when the price is right. And this leads us to the crucial difference between investing and speculating. An investor looks at a company's fundamentals, its business model, and its future prospects. A speculator, on the other hand, is swayed by market trends and the promise of quick profits. While speculation can sometimes lead to massive gains, it's also a road that can lead to ruin. As Graham puts it, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Now it's time to delve deeper into the key principles from the book. We'll be peeling back the layers of Graham's wisdom, revealing the core tenets that can guide you on your journey to becoming an intelligent investor. Remember, in the world of investing, knowledge is your most valuable asset. Did you know there's a difference between investing and speculating? It's a distinction that Benjamin Graham, the father of value investing, passionately emphasized. Let's start with investing. It's a methodical approach, a long-term game. When you invest, you're purchasing shares in a company with the expectation that over time, the company will grow, and so will the value of your shares. You've done your homework, you've analyzed the company's fundamentals, and you're confident in its potential. You're not hoping to make a quick buck. Instead, you're planting seeds for a fruitful future. On the other hand, we have speculating. It's more of a gamble, a bet on the unpredictable. When you speculate, you're buying shares with the hope that their price will go up soon, regardless of the company's fundamentals. You're not looking at the big picture. You're focused on short-term gains. It's a high-risk, high-reward game. But it's far from the steady path of investing. Now, Graham wasn't against speculating. He understood its appeal. However, he warned that it should only be a small portion of your overall financial strategy. It's like dessert, enjoyable in moderation, but it shouldn't replace your main course. Graham's focus was on long-term investing, on the slow and steady growth that comes from wise and calculated decisions. He believed in the power of compound interest, in the magic of time and patience. To be a successful investor, according to Graham, you need to have discipline and courage. Discipline to stick to your strategy even when the market is volatile, and courage to take advantage of the market's fluctuations. You see, Graham saw these fluctuations not as threats, but as opportunities. When everyone else is selling out of fear, a true investor is buying. And when everyone else is buying out of greed, a true investor is exercising caution. So remember, a true investor is not swayed by market fluctuations, but sees them as opportunities. Be patient, be disciplined, and let the magic of long-term investing work its course. Have you met Mr. Market yet? No, he's not a real person, but a metaphor created by Benjamin Graham. This character, Mr. Market, is a quirky fellow who represents the stock market itself. And oh, does he have mood swings. One day, he's brimming with optimism, offering high prices for shares. The next day, he's down in the dumps, ready to sell at ridiculously low prices. Now, you might be wondering why Graham would personify the market. Well, it's simple. By picturing the market as a person, we can better understand its erratic behavior. Just like us, Mr. Market has good days and bad days. But here's the interesting part. We don't have to let his mood swings influence our decisions. In fact, Graham suggests we do the opposite. When Mr. Market is overly optimistic, that's when we should be cautious. Why? Because high prices often mean overvaluation. On the flip side, when Mr. Market is pessimistic and prices are low, that's our cue to consider buying. This is because low prices often mean undervaluation, and undervalued stocks can be great investment opportunities. But it's crucial to remember that we shouldn't blindly follow his moods. We should do our own analysis and make informed decisions. Mr. Market is a tool to serve us, not a guide to follow. Here's where the concept of Mr. Market becomes even more valuable. It teaches us to be patient and disciplined. We should not panic when prices drop or become overly excited when they rise. Instead, we should stick to our investment strategy and make decisions based on our own research and understanding. So next time you're watching the stock market, remember Mr. Market. Think of his mood swings and erratic behavior. Use this concept to your advantage. Don't be swayed by the market's daily fluctuations. Don't let fear or greed dictate your actions. Instead, be patient, be disciplined, and make informed decisions. Remember, Mr. Market is there to serve you, not to guide you. Ever heard of the term margin of safety? Well, it's a key principle in Benjamin Graham's investing philosophy. Now, let's put it in simple terms. Imagine you're building a bridge that can carry a maximum of 10 tons. Would you design it to hold exactly 10 tons? Or would you prefer a bit of a cushion, say 15 tons, just to be safe? If you're like most folks, you'd choose the latter. That extra capacity is your margin of safety. And it's exactly the same concept that we apply in investing. The margin of safety principle is all about investing in stocks at prices well below their intrinsic value. This gap between price and value provides a safety cushion that helps protect investors from bad decisions and unforeseen market downturns. It's like buying $1 for 50 cents, which gives you a huge room for errors, bad luck, or extreme volatility in the market. Why is this principle so important? Well, it's because investing always involves a certain level of uncertainty. No one can predict the future, and even the most thorough analysis can't eliminate all risk. The margin of safety principle acts like a safety net, catching you when your investment decisions don't go as planned. So, how do we calculate this margin? It's not an exact science, but it involves estimating the intrinsic value of a company based on a thorough analysis of its fundamentals, and then buying at a price significantly lower than this value. The larger the difference, the greater your margin of safety. Investing using the margin of safety principle is a bit like treasure hunting. It's about finding hidden gems, companies that are undervalued by the market, but have strong fundamentals and a promising future. It takes patience, diligence, and a keen eye for value. Remember, the aim is not to buy a good company at a good price, but rather to buy a good company at a great price. It's about balancing risk and reward, not just chasing potential profits. The greater the margin of safety, the lower the risk, and the greater the potential for profit. Are you finding this intriguing? Do you want to become a more intelligent investor? Well, the journey doesn't end here. It's just the beginning of an exciting exploration into the universe of investing. Remember, every giant oak was once a tiny acorn, and every Warren Buffett was once a beginner. Imagine the power of compounding not just your money, but your knowledge as well. Benjamin Graham's wisdom is a treasure trove waiting for you to delve deeper. So why wait? Let's embark on this journey together. Take the first step by subscribing to this channel. By doing so, you're not just hitting a button. You're making a commitment to your future self. And don't forget to click on the notification bell. That way you won't miss any of our forthcoming videos filled with insightful content to feed your curiosity and sharpen your investing acumen. Don't miss out on the opportunity to enhance your investing knowledge and skills. Benjamin Graham once said, "The individual investor should act consistently as an investor and not as a speculator." This statement, as simple as it may seem, is the bedrock of successful investing. It's a reminder that investing is not a game of chance, but a strategic endeavor that requires thought, discipline, and patience. The principles we've discussed today, distinguishing investing from speculating, understanding the concept of Mr. Market, and appreciating the importance of a margin of safety, are all stepping stones on your path to becoming an intelligent investor. They are not just theories. They are practical guidelines that you can and should apply in your investing journey. To echo the words of another influential thinker, Albert Einstein, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Harness the power of these principles and let your money work for you. Remember, investing is not about making quick money. It's about making wise decisions for long-term financial security. So start thinking like an intelligent investor today.